Be afraid, very afraid of retiring in the 2020s. Actually, a real good article by my man JR here. JR and I have communicated on occasion via Advisor Perspectives. And I respect the guy, and I respect the work he does. And I think this article actually is a good piece of insight and information. A corresponding article from Brett Arendz over in MarketWatch, worst case scenario, warning for retirees. And frankly, I don't think JR's article, and he refers back to that. Let's just go over this a little bit. And we'll touch on some of this right here. They did a paper, this I thought was interesting. Since fear sells, our findings have attracted a modicum of attention in the financial news, including March 12th, 2021 MarketWatch article of worst case scenario warning for retirees, which we'll go into here in just a second. Our paper examined the 20-year investment period that began with the bear markets in 2000, 2002, which was followed by the 2007-9 bear market. Despite the dramatic rebound in advance of the stock market over the ensuing decade, we found the first 2 decades of the 21st century was among the worst 20-year periods in U.S. investment history. Specifically, consumers who retired at the beginning of that period and blindly followed the 4% rule are at considerable risk of running out of their money well before they run out of time. So remember, even if you... the last 12 years has been insanely good, but even the fact that you got killed on the front of that, the sequence of return risk. More ominously, especially for consumers approaching retirement, the 20-year period we examined does not represent a worst-case scenario. In fact, the strong performance of bonds as interest rates fell during the study period buffered total portfolio returns in a way that's not likely to repeat itself. Were we to experience similar back-to-back severe, prolonged stock market downturns with interest rates stuck at where we are today, the result might be a true black swan event that could make a 3% inflation adjustment withdrawal rate seem unsustainable over 30 years. All right, so we're just going to pause. I cannot agree more with what he says right here. I've done quite a bit of research on the implication of low bond yields and likely low equity returns with some other guys. As a result, I think it's always important to remind advisors, retirees, and pretty much anyone who will listen that most research on optimal retirement income strategies has been based on historical U.S. returns. Despite this fact, many financial advisors are still using historical long-range averages in financial plans, even though the yield on bonds is historically low, much lower than history. I cannot agree more. To support, we tested the 4% safe withdrawal rate using a couple different calculators, the Vanguard Retirement Nest Egg, the Big Picture app, his own eMoney, Monte Carlo analysis, and his own thing. And so basically, this is what drives me crazy about Vanguard. They're using historical returns in their own models. It's crazy to me because the Vanguard Capital's model market doesn't use historical rates of return. It uses projected. I don't know why they do it. So basically what's happening is JR is using his own Monte Carlo, is using his projected rates of return with low yields and whatnot. And I agree with that. And what he'll say is if you took 4% a year and you adjust it with inflation every year using his concocted Monte Carlo, you'd only have a 71% probability of success over 30 years, i.e. your money would run out 29% of the time. I completely agree. That's a good way to look at it. It's not good, man. No other way around that. So let's hold on just a second. Right here is what I love about JR, because he's a practitioner of financial planning. He actually has clients, and he says, on the research side, I applaud the ongoing effort of some academics to raise awareness of the unique risks our retirees are facing, but I take umbrage at their occasional patronizing rebukes of the financial advisors. Completely agree. Let's see. In a 2021 Plan Advisor interview discussing the problem that low interest rates pose for retirement portfolio sustainability, Michael Finke commented that there's a tremendous disconnect between academics and practitioners when it comes to annuities. We, academics, all know that annuities are the best tool to safely fund their retirement. Advisors must continue to consider using this tool if they're to do their job properly. That's as if academics know more than the advisors who sit with people. It's just freaking stupid. The academics is just economists, no different than the economists. We know, on the other hand, remember I said a video the other day that Harry Truman, he just wanted one-handed economist because on the other hand, this is like nuts, man. Academics think they're all down a bag of chips. Just ask them. But anyway, All right, so let's read a little bit what my man Brett here says, because this is good stuff right here, man. You got Eddie Murray, remember Eddie Murray played for the Orioles. Remember Eddie Murray? But here you got Eddie Murray. I think Eddie Murray was a lefty, if memory serves. And here you got Eddie Murphy screaming. All right. Those expected to retire soon will face a worst case scenario as a result of worse elevated stock prices and low bonds, says Jack DeJong, is a professor at the Nova Southeastern University, and John Robertson, who's a financial planner. Yep. Let's see. Okay, for those who retired in 2000, the 4% safe withdrawal rate will likely fail well before 30 years of most asset allocations, given the low interest rates. Yep. And even though stocks have boomed after 2009, it was too late for many retirees. Anyone who spent 4% in their portfolio in the 2000, raising it in line with inflation each year, had spent much of their savings by 2009. Too much to recover. I completely agree. That's known as sequence of return risk. Yep. Let's see. I ran my own model using a spreadsheet, the official CPI, and the returns from a rough and ready benchmark of a balanced portfolio, the Vanguard Balance, 60-40 stocks and bonds. In my calculations, those who retired in 2000 and applied the 4% rule, raising spending in line with CPI, are still okay 20 years on. They actually got about 88% of their initial portfolio left, but this assumes no taxes, no fees, or other costs. If you're paying 1% of your portfolio to an advisor, you've almost been wiped out. That's a huge piece of tidbits there, man. Yes, costs, including fees, can make that much difference. What's ominous for today's likely retirees is that the current math looks even worse than it did in 1999. That's because retirees typically hold a portfolio of stocks and bonds. And while stocks are not quite as expensive as they were in 1999, bonds are much more so than they were in 1999. That's the yields are low. All right. So today the same bonds pay about 1.6, which is they were paying about 4 to 4.5 back then. The lost decade of 1999 does not represent a worst case scenario because the bear market in stocks was accompanied by an extension of bull market in bonds. So what if we have a bear market in stocks and a bear market in bonds at the same point? I completely agree with that. That's my concern right there. A bear market in stocks and a bear market in bonds at the same time. So hold tight. So let's run our own Monte Carlo in the right capital and the numbers I use, which are based on the Vanguard Capital Models Market, VCMM, which is not what Vanguard does in their own retirement planning software, which is nuts. So we're going to have Katie Sample up here. She's 60 years old. She's going to live until she's 90, so for 30 years. Her entirety of her net worth consists of $500,000, and we're going to take 4% a year from that each and every year. So she needs $20,000 a year, 4%. Pretty simple. Are there going to be people? What about health care? What about? Just pipe down pipers. We're saying we're going to have $500,000 of assets. We're taking 4% a year, and we're adjusting for inflation. That's it. We're not getting too deep in health care because we're saying she needs $20,000 for everything. No one can live off $20,000. We're not having Social Security. We're not having anything. We're just saying she needs $20,000 a year off a $500,000 portfolio, 4%, and adjusting it for inflation. I guarantee there'll be people who say, "What about health care?" Don't hear this thing. Who can live on $20,000 a year? We're just sampling. I could make it $100,000, and she takes $4,000. What about health? I did that one time, and a couple people were like, "What about healthcare?" I said, "I can't win. But anyway, all right. So she's 60 years old. She's already retired. All right, and she's going to live until she's 90. All right, just to be clear here. All right, so there you go. She can live until she's 90. That's 30 years she needs income. And her net worth consists of nothing but the Vanguard Balance Index Fund. That's it. She's got $500,000 in the Vanguard Balance Index Fund and a 401k. All right, so she's going to have to pay tax on it. Let's make sure we're not doing expenses here. We're not going to do any AU. Okay, so no fees in terms of what she's paying. All right, so her portfolio, when you look at Vanguard Balance Fund, is 6238. I'm giving her all of a 5% rate of return. This target allocation is irrelevant, has nothing to do with you or her. We get 5% is her annual rate of return, her average annual rate of return with an 11% standard deviation. So just to be clear, what that means is we have okay, it's not working. We have 5% is our average. All right, blink 5. And we take this times 3. All right, so we got 30 plus 33 minus 33. So what this means is, let me make it myself bigger, is this is how you do it. You take that standard deviation, you times it by 3, and then you go to both sides of the average. So here's our bell curve, which means she could get 38% on any given year on the up, or down 28% on the down any given year, 99.8% of the time. That's how you figure out your standard deviation in terms of your volatility projections of your portfolio. So in any given year, she could lose 28% of her capital or gain 38% of her capital. Let me let the bunkie out here. Hope that makes sense. So basically, we're going to roll the dice. And we're going to say some years she'll be down 28%, some years she'll be up 38%, some years she'll be in between, and it's just a completely random order sequence of events. Now, the drawback about Monte Carlo, every roll of the dice for every year it has nothing to do with the previous year. And we know in terms of investments, the previous year does dictate future performance until it doesn't, but that's the drawback. And Monte Carlo, I know a lot of people bash it. It's still a pretty good program as long as you're using correct numbers. And so you'll see, I'm only using a 5% rate of return. So kind of going back to the worst case scenario, low interest rates on bonds, I'm only giving 2% bonds, 2% inflation, and I'm only giving you 6.5% on stocks. So that's where you get the 5% rate of return. All right, so let's see what we're looking at here in terms of her ability to survive for 30 years. 61%. All right, so 61%, and she'll leave her kiddos $79,000 in today's dollars. That's it. So going back to what JR was saying, he had 71%. And so I hate to say worst case. My stuff in this Monte Carlo is worse than almost everybody else because I do believe we're going to be a low return, low inflation environment for sure. I 100% think that's the case. All right, so just FYI, if you can make your numbers succeed in my stuff, you're probably in a pretty good place, if that makes sense. So let's go down here and we're going to say, what do I want to do here? So she already retired. We got to look at cash flows. So let's look at cash flows. Because remember, 20,000 a year did not include taxes. So actually she's taken not 4%, but she's taken 4.2% a year because of taxes, if that makes sense. All right, so basically, she needs 20,000, but she's going to pull basically 21,000 out the portfolio. Hope that makes sense. It's growing by 2% a year. The tax payments are going up, and so she's actually going to end up paying. And here's our RMDs because it's an IRA. She'll end up paying. This is the drawback. We're not looking at taxes. Let's go here. She'll end up paying $36,000 of taxes. All right, now the drawback about what you're seeing here, this is linear. So this all right here is linear. It just assumes a 5% straight linear rate of return. And that's not, you're not going to get that. So you always want to look at the analysis because this is a Monte Carlo where you have a confidence. You say, so you can see here, again, we're not taking, there's no Social Security, no healthcare, no nothing. Her portfolio is dropping. By the time she's 76 years old, 79, 5% of the time she has no money. 5% of the time she has $810,000. 25% of the time she has less than 130. All right, so that's a concern right there. So you can see that that's not good. All right, so what if we go and we say, what if she ends up paying a 1% management fee? And again, this is where it gets bad, man. If you're paying a 1% management fee, you're going to be in a world of hurt. It's funny how the rates of return go lower, the management fees haven't. I mean, they have gone somewhat, but not that much. It's going to be ugly. Let's say 28%. Let's see what we got. 28%. Current plan 44%. All right, so yeah, so you can see. What is that? Oh, I guess I could have done that here. Oh, sweet, yeah, right there. Oh, okay, there we go. Cool. So with 0.5. So basically, if she pays zero management fee, she's 61%. If she pays 1% management fee, is 0.45. That's why you got to negotiate your fees, man. If she pays 1/2 1%, it's what 56, 53%. So again, the management fees will really hurt because not only she got to pay taxes, but she's got to pay fees on that as well. All right, so what if we got a better rate of return? We'll just do a growth portfolio, which was my growth portfolios do. We'll see here in just a second. That doesn't change a whole lot now, does it? 60% with a 0.5 management fee, 0.5 point. 44% with a full 1% management fee. What is it with a 0% management fee? 67. So that's still not digging that. That's for sure. What do I want to do here? So we got, I want to go here, investments. And I can't remember my growth. Growth is 5.5%. So that's not going to get the job done. All right, so what if we go to a aggressive That's a 6% rate of return. Aggressive right here. What will that do? That's on average, by the way. 72. So still with any kind of well, that's a 0% management fee. So that 4% rule just won't work. I mean, it's just proven right here. It just won't. Now, on the other hand, what if we do this? What if we go to profile and we say we don't think her expenditures are going to increase each and every year? All right, so we're going to say retirement income. We're going to say no inflation, or let's just say 1% a year in inflation. All right, we'll say 1. So step 2, we'll say 1. What does that do? All right, so now we're going to go back to retirement. So instead of 2% is 1%. What will that do for our portfolio? It changes it quite a bit. So let's go to current allocation. And so no fees, current allocation, we're looking at 75% probability of success. So I cannot stress enough, if you watch your investment fees and you really don't think that your income needs are going to rise each and every year with inflation, that changes everything. I just cannot stress this enough. If you have a scenario where you think your expenditures are going to rise each and every year with inflation until you're dead, it's going to be a challenge. I just proved that to you. Here we got her increasing from 4%, 4.1, it's 1% a year inflation, not 2% a year inflation, it's 1% a year inflation, but still is increasing expenditures, and she's still at 75% with a 5% rate of return and a standard deviation of 11%. So that's still pretty fantastic, man. I'm comfortable with that for sure. Now, what if inflation is higher? And that's, if inflation is higher, her goose is cooked. There's no two ways around that. So we're going to go to goals, her income stream, and we'll say a 3% inflation. I mean, it's just not likely to happen because as people age, they spend less. But let's just say it did. This is going to be ugly. 44% on the current allocation with no investment fee, 27% on the current allocation with a 1% investment fee. So anyway, the two things you got to do is recognize what is your expenditures likely to do as you age. I'd do some due diligence and research. Research what people you know. Ask around to retirees, old people, your grandma, hell, it might be your parents. Say, hey, what have you noticed about your expenditures? Have they gone up? Ask around people who have actually had healthcare issues. Say, hey, what happened to your expenditures? What we found is most healthcare expenditures are really in the last 6 months of life, if that makes sense. So it's just not likely to happen, but ask around, do some due diligence. Say, look, I'm ready to retire. Have you seen your expenditures level off as you got older, drop even? And then that gives you something more than just some academic who says, oh, annuities are the way to go, because they might be, but these academics know. So anyway, love to hear your thoughts. Thanks now.